When it comes to everything in life, certain behavioral traits tend to affect the decisions that we make, and that's also the case when you talk about investments. In fact, there are some very key behavioral biases that affect our decision making and could lead to a warping in the way our portfolio is built, a change in the way that it is built, and therefore finding out what those biases are and identifying them is the first step that you need to take to bring things back on track. Join me to talk about this in more detail is Santosh Navlani, Chief Operating Officer of ET Money. Thank you so much, Santosh, for taking the time. There is a lot that you can say when it comes to these biases, and there are 5 that you have identified. So I thought let's go through these one by one and identify what they are and how they can be fixed. The first one is a loss aversion bias. Could you tell us about this and how it can be fixed?
Yeah, so before I come to the loss aversion bias, Alex, I think it's important to understand what biases are in first place. Conventional economic theories will tell us that human beings are very rational beings, and they take into account all the information before taking a decision. And it sounds all pretty nice to hear, but the fact is, when it comes to things where we tend to get a bit emotional, a lot of cognitive biases come in the way of effective decision making. And money is such an emotional topic for most people, if not all, that it's only human to act in a way which may not be one's best interest in the long run. And biases and understanding these key biases can actually help us overcome these behavioral issues and help us basically become richer and maybe more financially free, at least with respect to personal finance decisions we make in life. So the first one, loss aversion bias, is basically stems from the fact that as human beings, we typically hate to lose more than what we love winning. Typically, if there are scenarios, for example. Let's take a case of you basically finding something like a 100 rupee note of fall on the ground, and you pick it up and keep in the pocket and move on, feel happy about it. And I imagine a different scenario where you basically find 200 rupee note and you happily pocket them as well and move on. But in second scenario, if by any chance you suffer from pickpocketing and you lose one of those 100 rupee note and left with only 100 rupee note, the pain that you will have in scenario 2 probably will be more than the pain or the happiness that you will get in the scenario 1, despite the fact that in both the cases you got richer by rupees 100. Now, this is what happens in reality with investments as well. Now, many a times we actually look at the fact that we have made some money in the marketplace and we exit at a profit. But if that mutual fund or stock continues to rise, that the happiness of booking profit disappears, and basically the opportunity loss of the extra money that we could have pocketed by staying invested starts affecting us more. So we always tend to remember losses more. And because we tend to remember losses more, we actually sometimes become risk averse. And that comes a lot in the way of wealth creation in the long run, which is all about making calculated risk and creating long-term compounding for yourself. So the more you are bothered about the losses and you remember those things more often and make them come in the way of effective decision making, it actually starts affecting your wealth creation a lot.
Okay. But how do you fix something like a loss aversion? Because this, I would think, would force you, for example, to go for a fixed deposit when for the long term your equity investments would be more appropriate.
Yeah, so I think one of the most recent things, and we can again fall back to March 2020 during COVID. Many people suffered losses in their investment portfolios, be it mutual fund only portfolios, a mix of equity, direct equities, and mutual portfolios, and maybe because of the red in the portfolio or the continuous falling values, one basically got no risk covers and maybe booked some profits book some losses or avoided investing that point of time. But the fact is, most of the Indians would actually not be having more than 15-20% of their entire net worth into equity markets or capital markets. As a country, we hardly have 5% exposure of our entire financial savings into areas like mutual funds and direct equities in that sense. So despite the fact that our net worth, the entire portion of mutual fund equities may not be significant part of our net worth, you only look at that aspect of loss and act in an unwise manner. Whereas if you were to look at the gain or the loss in the context of your entire net worth, maybe you would act differently, because you may be worth, for example, 1 crore across all your assets like real estate, land, gold, physical assets, or FDs on mutual funds and equities as well. But only about 20-30% of your net portfolio was in equity assets. All you would have lost is basically about your 30 lakh rupees would have basically gone to about 20 or 15 lakh rupees at backs. And that loss is hardly like 10% on entire net worth of 1 crore. But then if you only look at that loss feeling that one part of the portfolio, you will take a wrong call. So to avoid loss aversion or the bad effects of acting on those things, look at the entire picture of your net worth and asset allocation, and take a judicious decision based on that instead of only looking at one part of your portfolio.
Okay. The next bias is actually something I think a lot of people will have heard about, and that is the herd mentality bias, which means that if a lot of people are thinking something, you tend to agree with them, and that's not necessarily a great idea when you're talking about financial instruments, right? So Santosh, what can you tell us about this herd mentality bias and how to fix it?
Yeah, so I think one of the most common thing, as you rightly said, is this herd mentality that typically this word gets used a lot in market parlance as well, where suddenly if everybody believes that markets are going to rise and rise and rise, everybody starts believing, and then the market peaks actually combine with the confidence peak of people, and a lot of money starts coming into the assets, risky assets for that matter. And this not just apply to equity markets, it can apply to real estate, it can apply to gold, it can apply to cryptocurrencies for that matter. Everywhere where people believe that, suddenly lot of people start believing that it's actually good, and it starts affecting your own decision making as well. You would tend to go with the flow and not bother about the risks involved in the place. And one of the ways to overcome this bias is actually have an asset allocation plan at the back of your mind always, that what you're supposed to follow. So if the asset that you are holding money, and maybe you're holding a diversified portfolio, there is equity, there is gold, there is debt, there is real estate, or maybe there is cryptocurrencies as well. And one of the ways to really kind of avoid the side effects of this bias is keep an eye that if you are supposed to only have 20% in the cryptocurrencies or only about 20% in equities, the moment you are sitting on handsome gains and this 20% equity contribution suddenly in the entire portfolio starts looking like 30% contribution, it's time to take 10% off the table and go back to 20%, at least in this herd mentality behavior that is you are getting beneficiary of because your asset prices are going up. You will take some money off the table, come back to 20, and at least be able to convert some paper profits into real profits. So having an asset allocation plan or a strategic plan to your investment goals in life can actually help you avoid the traps of herd mentality.
Yeah, in fact, it makes you think about the Warren Buffett quote, which is, I get fearful when others are greedy and get greedy when others are fearful. This automatically helps you do that, I think. The next one, I think, is mental accounting bias. And I don't think that a lot of people would have heard about this, Santosh. What's it about?
Yeah, so basically, it's about the fact that one values money, more importantly or less importantly, based on the source of that money that you get from. So, for example, we all work hard in our businesses and our salary for our jobs and earn the salaries or income with a lot of blood, sweat, and hard work. And we tend to value that money far more, importantly, judiciously, than actually something which may come out as inheritance, or something which may come across as an appraisal bonus that you were not expecting, or something unexpected windfall from some kind of gain that you will suddenly make from an asset which you probably written off or you forgot about. So the money which suddenly comes, which you're not expecting or you didn't really work hard for, you will tend to value that less importantly with respect to risks and return expectations, or just being more rational about how you're going to spend about it compared to the money that you work hard for. So based on source of income, if you start valuing money differently, it's called mental accounting bias. So suddenly, for example, you were not expecting a big bonus in annual appraisal cycle, you got a big one. You may actually spend it very differently compared to how you spend your salary, or you may spend it or invest very differently compared to how you invest your other income. It also comes from the fact that we don't really calculate things properly enough, where as our incomes start growing, we don't really start valuing our savings or inflation that much. So, for example, something which costed 100 rupees 5 years ago, and it is costing only 100 rupees today, you don't really think that it has become cheaper, despite that you've been earning a lot of money and your salaries or your income is going up every year. So it's mental accounting bias in that sense. When I was earning, for example, 50,000 rupees per month as an individual investor, for example, talking about, you may be having an SIP of 5,000 rupees. But when the moment your salary becomes 1 lakh rupees, you're still doing 5,000 rupees, whereas you should be actually doubling up to 10,000 rupees. But 10,000 rupees suddenly sounds a very big SIP number in your head, despite the fact your income has doubled. So these kind of mental accounting biases, because you don't really tend to value numbers properly compared from source of income, from inflation, from your own financial stability standpoint, comes in the way of effective decision making. And one of the ways to actually overcome this bias is actually having goal-based investment plans. So when you know that you are going to invest this money for your children's education, for your retirement planning, for your second home, maybe for a vacation, the moment you have a goal in mind, a target value in mind, you would know that I need to invest so much at least to be able to reach that goal in time. And suddenly you will be able to overcome the mental accounting bias.